So, there's a massive tax overhaul coming to India in 2026, and honestly, it's causing a huge amount of confusion. The new Income Tax Act is changing everything, and if you're feeling a little lost in all the noise, trust me, you are not alone. So, in this explainer, we're going to cut right through all of that and give you the clear, actionable info you really need to know.
Okay, let's just dive right in and rip the Band-Aid off. We're going to tackle the biggest rumor head on, the one question that's causing so much anxiety out there. Has the 10 crore rupee turnover limit for deducting TDS on purchases actually been scrapped? Well, the short answer is no, but the reason for all the confusion? That's what's really important here.
So, you might be wondering, why is everyone so mixed up? Well, it's not because the fundamental rules have all been tossed out the window. Instead, think of it like this. The government took the entire tax law, shredded it, and then pieced it back together like a brand new puzzle. Section numbers we've all memorized? They've changed. Definitions? They've moved. And this massive reshuffling is causing people to completely misread rules they've known for years.
And this number, well, this is exactly why getting it right is so incredibly important. The stakes are just sky high. A simple mistake, a small misinterpretation, or just failing to properly report something could lead to a jaw-dropping tax and penalty of up to 84% on any wealth the department decides is unexplained.
So what in the world is unexplained wealth? Well, it's a really broad term. It could be any money, any investment, any asset, or even a big expense that isn't properly accounted for in your tax returns. Basically, the tax department is tightening the screws. And the new message seems to be, if you can't explain it, we're going to tax it, and tax it hard. And if that wasn't enough, there's a very big deadline looming. You see, in the past, you had a pretty generous amount of time to go back and fix any mistakes in your TDS returns. But with the new act, that window is shrinking fast. You now have until March 31st, 2026 to correct any errors for the financial year 2023-24 and anything before that. After that date, that door slams shut for good.
And you know, this new era of accountability doesn't just stop with income tax. Let's switch gears for a second and talk about something else causing a lot of sleepless nights: GST. Picture this. You do everything right. You buy some goods, you pay your supplier, GST included. But what if that supplier just pockets the tax money instead of paying the government? Well, you might be the one who ends up paying the price. Okay, let's circle back and really understand where that TDS confusion came from. You see, in the old 1961 Act, everything was nice and tidy. The rule, Section 194Q, and the definition of who a buyer was, they were right there together, super simple. But in the new 2025 Act, the rule has been moved to Section 393, and the definition of a buyer has been completely relocated to a separate table, and that's why everybody's getting lost. This right here, this just illustrates the new tax treasure hunt perfectly. In the old days, you just had to know one thing: Section 194Q. That was it. But now, it's a whole journey. You have to find Section 393, then you have to jump over to Table 8, and then you have to find serial number 2. It's a totally different way of thinking. It's not about memorizing anymore, it's about knowing how to navigate.
And after that whole adventure, what do we find? Well, here's the answer, the solution to the big myth. The definition of a buyer who needs to deduct TDS is crystal clear. It is still a person whose turnover was more than 10 crore rupees in the previous tax year. The limit never disappeared, it just moved to a new address.
So let's just make this super clear. For the financial year 2026-27, you only have to worry about deducting TDS on your purchases if your own business turnover in the previous year, that's 2025-26, was over 10 crore. The rule itself has not changed at all, just its location in the law books.
Now, let's apply this same idea of accountability over to GST. This slide shows what we call the broken chain problem perfectly. Ideally, the system works like a charm. You pay your supplier, they pay the government, you claim back the tax you paid, your input tax credit, or ITC. Simple. But the problem starts when a supplier breaks that chain. They take your money, but they never pay the government. And the result? The tax department can actually come after you, the honest buyer, and say, nope, your ITC is denied.
But there is a ray of hope here. High courts are actually starting to side with taxpayers, basically saying that you shouldn't be penalized for your supplier's mistake if your purchase was totally legit. But, and this is a huge but, there's a critical catch. The responsibility, the entire burden of proof, is now on you to prove that your purchase was genuine. Okay, so how do you actually prove it? This right here is your essential checklist. To defend your ITC claim, you absolutely must have a valid tax invoice, the e-way bill for transportation. You need to see that transaction reflected in your GSTR 2A portal, have solid proof of payment to the supplier through a bank, and of course, proof you actually received the goods. This pile of documents, this is your shield.
All right, so we've busted the big TDS myth, and we've unpacked the huge GST risk. Let's get practical. What do you actually need to do? Here is your compliance checklist, the real, concrete steps you need to start taking to stay safe as we get closer to 2026.
So here are your key dates and your to-do list. The most urgent thing on this list? Go back and review and correct any old TDS returns before that March 31st, 2026 deadline hits. Then, during the next financial year, you've got to keep a close eye on your turnover. And starting in April 2026, you need to make sure your new, much stricter documentation process for every single purchase is up and running.
So for every single business owner watching this, here's the number one takeaway. Your paperwork is your power. Organized, detailed, robust documentation is your best defense. In fact, it's pretty much your only defense. This means keeping a dedicated file for every single major purchase with all those documents we just talked about. It's all about being proactive, not reactive. And for all the tax consultants out there, the game has changed for you too. It is now absolutely essential that you protect your practice. Because let's be real, when a client gets a tax notice, who's the first person they might blame? You. So the solution is to get written confirmation for everything, an email, a signed declaration, whatever it takes for all those ITC claims. In this new world, documentation doesn't just protect your client, it protects you. So after going through all of this, the new section numbers, the court cases, the deadlines, what's the big picture? What's the one thing we should really be taking away from all this change? Well, the real story here isn't just about shuffling section numbers around. What we're seeing is a fundamental shift in philosophy. The government is signaling a brand new era of transparency, of accountability, and of diligence. They are demanding clear, provable, documented evidence for every single transaction from everyone involved. And so, I'll just leave you with this one question from the slide. Is your documentation strong enough for 2026? Because the era of casual, we'll get to it later record keeping is officially over. The government systems are getting smarter, the penalties are getting much, much stricter, and the time to get ready isn't next year or even next month. It's right now.